Exercise 10-5. Happy Valley Pet Products uses a standard costing system that applies overhead to products based on standard direct labor hours allowed for actual output of the period. During the recent year, the following data were collected, so we're given some information there, and then we are asked, number 1, compute the fixed portion of the predetermined overhead rate for the year. So the fixed portion, the predetermined overhead rate. So it's your fixed overhead divided by your denominator level of activity. We're told it's based on direct labor hours, so that's going to be our denominator. So fixed overhead, so it's our budgeted amount for the year at $40,000, divided by our denominator level of activity, and that's direct labor hours, and the budgeted amount for that was $10,000. So that works out to $4 per direct labor hour. Then we are asked to compute the fixed overhead budget and volume variances. So the budget variance. Now here, we'll use the formulas. Budget variance is actual fixed overhead cost minus flexible budget fixed overhead cost. So your actual given to us, $38,000, and the flexible budget fixed overhead cost is our budgeted amount that was given to us here at $40,000. You subtract that, you get negative $2,000. If it's a negative number, it's favorable. Our volume variance is the fixed portion of the predetermined rate, so that's what we calculated up here in part 1 at $4 per direct labor hour, multiplied by your denominator hours minus your standard hours. So our denominator hours was the budgeted amount here of $10,000 less your standard hours, and that's given to us directly. The standard hours allowed for the actual amount of output is 9,000. So if you work out the math there, you get positive 4,000. It's a positive number, therefore it's unfavorable. Here they kind of do just a reconciliation just to help with understanding. So we're going to do a reconciliation of underapplied fixed overhead to the budget and volume variances. Now, this is not necessary unless it's specifically asked for, but it just helps with understanding a little bit. So actual fixed overhead, the actual amount incurred was $38,000. Applied fixed overhead, so that is applied would be standard hours times your rate of $4 per hour, that's $36,000. So we underapplied, or they underapplied overhead by $2,000. They applied $36,000, the actual was $38,000. So the underapplied overhead. And if you look at your budget variance of $2,000, your volume variance of $4,000, so favorable of $2,000, unfavorable of $4,000, you will, if you add them together, you will get a $2,000 unfavorable. That's what they mention. Unfavorable is the same as saying underapplied. So that's how this reconciliation kind of just helps with the understanding and seeing what's going on a little bit better.